All right, let's talk about a chapter that's a real double-edged sword in your CA inter exams, the applicability of accounting standards. It's one of those topics that can be a goldmine for marks, but it's also packed with tiny, tricky rules where students slip up all the time. But don't worry, by the end of this, you're not just going to understand the rules, you'll know exactly how to sidestep all those common traps. Let's get this mastered once and for all.
So, let's dive right in with a classic exam trap. Picture this. A firm ticks all the boxes to be classified as an MSME, a micro, small, and medium-sized entity. This is the very first year it's qualified, so can it immediately start claiming all those juicy exemptions from the accounting standards? Now, your first instinct is probably to say, yeah, of course. But hold on, because that's exactly the trap ICAI loves to set. The correct answer is a big, fat, and no. Stick with me, and I promise you I'll show you exactly why, so you never ever fall for this one in the exam hall.
And this is where things get really interesting. Just look at this slide. On one side, we have Ravi Traders, a partnership firm. On the other, Zen Private Limited, a company. Now look at the numbers. Ravi Traders has a way higher turnover and much bigger borrowings. So logically, you'd think it would have to follow stricter rules, right? Well, that's where you'd be wrong. The rules are totally different, simply because one is a company and the other is not. And that, my friends, is the heart of this chapter. You have to become a master of two completely separate sets of rules.
Okay, first things first. Before we even start thinking about turnover limits, borrowing limits, or any of that stuff, we have to lay the groundwork. We need to get a grip on the foundational principles of applicability. These are the absolute first principles you've got to check every single time. So, before you even look at a single number, you have to ask yourself these three core questions. Think of it like a three-gate security check. Gate 1. Does the standard even apply to this type of business, this enterprise? For most businesses, the answer is going to be yes. Gate 2. Does it apply to the financial statement we're making right now? And finally, Gate 3. Does it apply to the specific line item we're dealing with? You need a yes at all three gates before you can even proceed. It's non-negotiable. This brings us to a super important concept, materiality. See, accounting standards don't really care about tiny, insignificant things. They only apply to material items. But what does material really mean? Well, here's the classic example that ICAI absolutely loves to test. Imagine a huge company with a turnover of hundreds of crores gets a tiny 50,000 rupee penalty. Is that material? The amount is pocket change for them, but the answer is a massive yes. Why? Because it's not about the size of the number, it's about the story it tells. A penalty means they broke a law, and that's definitely something an investor would want to know. So please remember, materiality is all about the impact, not just the amount. Okay, let's clear up another huge point of confusion, the difference between accounting standards and the Income Tax Act. The easiest way to think about it is that they speak two totally different languages. Accounting standards speak the language of true and fair. Their goal is to give investors a clear picture. The Income Tax Act, on the other hand, only speaks the language of calculating how much tax the government gets. A perfect example is a finance lease. For accounting, the person using the asset claims depreciation, but for tax, only the legal owner of the asset can. They are two different rulebooks with two different goals. It's so important that you don't mix them up. All right, with the fundamentals locked in, let's dive into our first big category, the non-company entities. We're talking about your partnership firms, LLTs, sole proprietors, trusts, you name it. For these guys, the big question is, are they a micro, small, and medium-sized entity, an MSME, or do they get pushed into the large entity category? Okay, pay super close attention here. This slide is a make-or-break one. To get that MSME tag, a non-company has to satisfy all 5 of these conditions. I mean it. If it fails even one, just one, it's out. It becomes a large entity and has to follow all the rules, no excuses. Now, the 2 that get tested the most are turnover and borrowings. But here's that classic ICAI twist you have to watch for. For borrowings, the limit is 50 crores at any time during the preceding year. They'll give you a question where the opening and closing borrowing is, say, 40 crores. But they'll sneak in one little line that says, oh, but on June 15th, it touched 51 crores for a day. That's it. Game over. The condition is breached and it is not an MSME. Watch out for that phrase. So let's say an entity successfully navigates those 5 tricky conditions and qualifies as an MSME. What's the reward? What's the prize for clearing all those hurdles? Well, the prize is a whole bunch of exemptions and relaxations. And this is where you can pick up some really solid marks just by knowing the rules. So what are these rewards for being an MSME? Well, first off, some accounting standards are just completely off the table. AS3, 17, 20, and 24, gone. You just don't have to worry about them. But then it gets a little more interesting. There's a second level of exemptions for the really small MSMEs. If your turnover is under 50 crores and your borrowings are under 10 crores, you also get to skip AS18 and AS28. So just think of it as a two-tier system of exemptions.
Now, it's not always a full exemption, a complete get-out-of-jail-free card. For some standards, MSMEs get some really helpful relaxations that make life a whole lot easier. For instance, in AS 10 and 11, you can just skip certain disclosures that are encouraged but not mandatory. But the really big one is AS 15, employee benefits. The relaxations here are a total game changer. You don't have to do all those complicated discounting calculations for long-term benefits, which is a massive time saver. And for AS 19, you get to skip some of the nitty-gritty disclosure paragraphs. These relaxations really do make a big difference.
Let's keep going with these relaxations, and here's a really big one you absolutely need to remember for your exam. AS 22, accounting for taxes. For an MSME, creating deferred tax assets or liabilities is optional. That is a huge simplification. Then, for AS 28, even if you do have to apply it, you can calculate the value in use based on a reasonable estimate, which saves you from those painful present value calculations. And just like we saw before, for AS 26 and 29, you get to skip some of the more detailed disclosure paragraphs.
And here we are, back to our very first question. This is it, the big one, the exam trap that costs so many students precious marks. An entity that qualifies as an MSME for the very first time cannot, I repeat, cannot claim these exemptions in that first year. It has to prove itself. It has to maintain that MSME status for 2 consecutive years. Only from the 3rd year onwards can it start enjoying all these benefits. Please, please, please burn this rule into your memory. It is an absolute favorite for ICAI.
Okay, so what about the opposite situation? An MSME does really well, it grows, and it breaks one of those 5 conditions. It's now a large entity. What happens then? Well, the rule is pretty straightforward. From that current year forward, it has to apply all the accounting standards in full. The exemptions are gone. But the critical point here, and this is where marks are often lost, is that you do not go back and restate the previous year's numbers. You just draw a line in the sand, move forward with full compliance, and make a note disclosing the change. That's it.
Whew. We have absolutely covered non-company entities. Now it's time to switch hats completely and enter the world of companies. Over here, the game is different. The rules are governed by the company's accounting standards rules, and the main classification is between small and medium-sized companies, or SMCs, and of course, non-SMCs.
Now, just like MSMEs, these SMCs get their own special set of exemptions and relaxations. But, and this is a huge but, here is my big warning to you. The rules are not the same. This is such a classic ICAI move. They'll give you a company in a question and tempt you to apply the MSME rules you just learned. You cannot fall for it. Let's get crystal clear on the specific rules that apply only to SMCs.
All right, let's break down the perks for being an SMC. First, the easy one. The only standard that's completely off the table is AS 17, segment reporting. Simple enough. Then we get to the relaxations. For AS 15, it's pretty similar to the MSME rules, but there's a key difference. You still have to use the projected unit credit method. Now for AS 20, you do have to show basic EPS, but you get a pass on showing diluted EPS. And just like with the MSMEs, you get to skip some disclosure paragraphs for AS 19 and 29, and you can use that handy, reasonable estimate for value in use in AS 28.
Okay, this slide right here, this is your cheat sheet. This is your golden ticket for not getting confused between MSMEs and SMCs in the exam. Now, the turnover and borrowing limits are different, sure, but let's focus on the 2 differences that will absolutely save your skin. First, AS3, cash flow statement. Not applicable for an MSME, but it is 100% mandatory for an SMC. Second, AS20, earnings per share. Totally not applicable for an MSME. But for an SMC, you have to show basic EPS. Only the diluted EPS is exempt. Please, please, burn this table into your brain.
We have covered a huge amount of detail. I know. So now it's time to boil it all down and focus on the absolute must-know points. Think of this as your final revision checklist, the stuff that's going to stop you from losing any easy marks on this topic.
All right, final recap. Here are the top 5 exam traps you need to tattoo on your brain. 1. MSME and SMC rules are different animals. Do not mix them up. 2.
That 2-year waiting period for new MSMEs, it is a non-negotiable, solid rule. 3. If an MSME loses its status, you apply the new rules from today forward, but you do not touch the past. 4. Materiality is about the story, not just the size of the check. And 5. That sneaky borrowing limit for MSMEs has to be checked at any time during the year, not just on March 31st. Keep these 5 points front and center, and you will be in fantastic shape to handle any question they throw at you.